All right, so this is the question that we are looking at. Frank's Bakery rents a shop in Chawama compound from which it sells bakery products. The following balances were in its books of accounts at 31st December 2023. Okay, so here we've got all the accounts and all the balances. All right, so before we even go to the additional information, here this is where we do the accounts classification so that we know where which account goes to. So colleagues, remember what I said for the income statement, which includes the trading account and the statement of profit or loss. There you're only going to see revenues and expenses. Can we write this down so that we do not forget this? For the income statement, which is trading account, and the statement of profit or loss. Okay, there you're only going to see expenses and revenue, and also contra expenses and contra revenue. Then for the balance sheet, okay, that's where you're going to find assets, liabilities, and capital accounts. Okay, yes. So colleagues, revenue, where does it go? Eesh, nobody. Which financial statement will revenue go to? Income statement, yes, under the trading account. What about purchases? Yes. Purchase returns? Yes. Income statement is a combination of the trading account where you get your gross profit and the statement of profit or loss where you get your net profit. The gross profit comes after you remove the expenses for doing business. Okay. And the net profit after you deduct the operational, distribution, the interest expenses. Allowance for recoverable debts. This is a contra asset account. It reduces the receivables amount. What it is since every business does credit sales. Okay. Now we know that it's not all the time that everyone is going to pay you back. Okay. So sometimes you can estimate. This is what we call the allowance for recoverable debts. Okay. We estimate, okay, and say, okay, usually you have a percentage, then you get the percentage of the receivables amount to get this allowance. Okay. So this allowance for recoverable debts, this is just an estimation of the money that we might not get back. Colleagues, are we okay with that? It's an estimation of the money we think we might not get back. Okay. That's allowance for irrecoverable debts. So you usually see it, it deducts, you deduct it from the receivables amount. Okay. But there's also a special process that happens, which you're going to see once we reach the additional information. For now, we just want to first focus on accounts classification so that we are all okay. Okay, so wages, rent and rates, electricity and water, advertising in the income statement under the statement of profit or loss. What about this inventory 1 October 2020? Colleagues, what is this representing and where will we find it? Yes. But this opening inventory, you're going to find it in the trading account. Yes. The closing inventory is the one which you find in the trading account and in the balance sheet. Okay. Opening inventory is the one you find in the trading account, yes, but closing inventory, you find it in both statements. Okay. And closing inventory is usually given in the additional information. Yes, because we've seen a beginning of a month. Although I think there was a typing error because this is for 2023 and here this is 2020. I think it's a typing error. Mhm. Please find out from the lecturer because I know in your group discussions there will be heated debates. Insurance. Okay, we know where this goes. This is an expense income statement. Non-current assets. Colleagues, where are these going to go? Yes. Provision for depreciation. This is a contra asset account. It's also called accumulated depreciation. Okay, what happens is each year as you are calculating the depreciation expense, the accumulated depreciation is building up. And as it builds up, the value of the asset goes down. Okay. As the provision for depreciation goes up, the value of the asset goes down. That's why you're going to see in the balance sheet, the first section, you're going to deduct the provision from depreciation from the value of the asset. Are we okay with that? Trade payables. Uh huh. Okay. Okay. Each Remember, depreciation is the loss in the value of an asset. Okay, it's the loss in the value of an asset. So each year, okay, when you calculate the depreciation expense, okay, when you do the journal entry, you debit depreciation and you credit provision of depreciation. So as the years go by, provision for depreciation increases. And as provision for depreciation is increasing, the value of the asset is going down. Okay. So it's a contra asset account because it reduces the value of an asset. Yes. So you're going to see, as I said, in a balance sheet, that's one of the first things that you're going to do. You're going to see provision for depreciation deducted from the value of the asset. Okay, trade payables. Where is that going? Okay, general repairs. Yeah. Uh-huh. Capital, drawings. Wait. Capital income statement. No. No, sir. Please do not put capital on the income statement. Anywhere in the trading account or the statement of profit or loss. Please. Drawings. What are drawings? Yes, for our personal use. Add for personal use. Okay. That's why a lot of entrepreneurs don't succeed because drawings. Yeah, you make your first 50,000, you want to pay yourself. Drawings. Carry as a sole trader, you and the business are one, right? You're not separate. Bank overdraft, 5% bank loan, bank charges and loan interest. No. Mm-hmm. Yes. Sundry expenses. Okay. Commission receivable. Excuse me. Both. Yes. Because this one, commission receivable, the way it is you have done some work for someone, so you've earned a commission. The person hasn't paid you, but remember, according to the accrual concept, whenever you earn revenue, you record. Okay, so that's the income side of it. And then since the person hasn't paid you the commission, they will receive a. Okay, so the receivable part to go to the balance sheet, then the revenue side of that transaction go to the income statement. Any questions on that? Because remember, this is accounts, colleagues. Very confusing course. Very confusing. Are we okay with that? Madam Betha, Mr. Dominic, Mr. Foster, Mr. Frederick? Yes, commission receivable. You've you've done work for someone, they're owing you a commission. So that commission is income to you. But since you haven't been paid, so that person is owing you. That's why the receivable part. But take note, if you just see commission received, not receivable, but commission received, that one is just going to go on the income statement. Okay. Any questions? If you see commission received, that's going to go to the income statement. Okay. So now, whenever you're dealing with questions with financial statements, before you even start making those financial statements, there are some adjustments you want to go through. Okay. There's this additional information. You have to look at this additional information first because it means there will be some adjustments that you need to do. Okay. So we'll be walking through each adjustment one at a time. Okay. So the first here, this inventory of 8,000. Okay. This is our closing inventory. Okay. The inventory you find in the additional information, that's your closing inventory. The one that you find in your, what do you call this? Uh, where in the list of accounts, that's the one that just goes, that's the opening inventory, and that's the one that goes into the trading account. Okay, so this is our closing inventory, 8,000. Additional information number two, wages 550 kwacha are owing. Oops, let me just put my phone on the charger. Yes. So this is an accrued expense. Okay. This is an accrued expense. So what we're going to do is we are going to add it to this wages amount here. Okay. We're going to add it to the wages amount, and this same 550 is going to be treated as a current liability. I repeat, wages 550 kwacha, which are owing, means we haven't paid for these wages. Okay. And remember, according to the accruals concept, whenever you incur an expense, you record. Okay. So here we've incurred, there's this wages amount of 550, which we haven't paid. So it means we are owed. Okay. So you add this amount to the wages amount. Here. Okay. So basically, you're going to do this. Yeah. 550 plus 4,850, you get 5,400. So on the statement of profit or loss, this is the amount that you're going to put, 5,400. Okay. Then in the balance sheet, you're going to put this 550, which is owing. Are we okay with that, colleagues? Okay. At least I need to hear two I'm okay with it. Because at least if three people are okay with it, then it's those, from those three people it becomes nine, then nine, then okay. Okay, the next adjustment they've told us general repairs included 6,000 for the purchase of a new computer. Okay, so colleagues, this is where I have to introduce you to capital expenditure and revenue expenditure. Okay, capital expenditure, this is the money that you spend for buying assets. Okay, anything that is included when you're buying the asset. For example, if you're buying a car, you buy it new tires, you service the car, you paint the car. Okay, all of that is going to fall under capital expenditure. Okay, whenever you purchase an asset, okay, and any expenses attached to that asset, that is capital expenditure. Then revenue expenditure, this is money for it's for operational expenses. Okay, when you're buying your inventory, paying for salaries, wages, and whatever. So here under general repairs, this 6,000 has to be removed because it's for a new computer. Okay. So this 6,000 has to be removed from this amount for general repairs, which is here 8,900. Okay. You remove that 6,000 for the purchase of the new computer. So you deduct 8,900. Where did I put that? 8,900 minus 6,000, you get 2,900. So this 6,000, you're going to add it to the value of the computers, and then in the statement of profit or loss, under general repairs, you put 2,900. Any questions? Mm-hmm. It's for the purchase of a new computer. It's for the purchase of a new computer. Yes, the general repairs, they included the amount for the new computer. So that amount for the new computer has to be removed from. Hey, whose mic is on? Whose mic is on? Yes, that 6,000 is for the purchase of a new computer. As I said, capital expenditure is money that you use to buy assets. Okay, so that 6,000 is going to be taken to the balance sheet and is going to be added to the cost of the computers, basically the value of the computers. Okay, it's not part of those general repairs unless the question said those general repairs were for that computer, then the whole 8,900 would have even gone to the balance sheet. Okay, so the 6,000 represents the purchase of a computer. It's capital expenditure. It's not revenue expenditure. Yes. Yes, is that a question? So you remove it from the amount, that 8,900. Okay. Mhm. Uh-huh. Yes, yes, yes. Yes, but remember, one of the computers was revalued. So first, we have to also do that revaluation. Then we get the total. With deducted 8,000. Remember, general repairs included this 6,000. So we're removing it. Yes. Oh, this one's going to go in the thing, statement of profit or loss. No, 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 no. No, no, no. He said he was asking this 6,000, if we add it to this 8,000 here. Yes, and I said, yes, you're going to add it to this 8,000, yes. But there's a revaluation that has to happen first, then we get the total. Then the 2,900 goes to the statement of profit or loss. I hope, are we clear there? Okay. Mhm. Yes, I think it was this one. Where was this? Computers by revaluation. Yeah, computers were revalued at 7,500. So it was 8,000. Now it's revalued at 7,500. 8,000 minus 7,500. There's a loss of 500. Yes. So this loss will be treated like depreciation. Yes, you subtract. Yeah. Wait, wait. Say that again. Say that again, sir. 8. Uh-huh. Yes. Yes. You're going to add a revaluation. Yes. No, this 500 is going to go in the statement of profit or loss. It's to be treated like depreciation. No, 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 no. It will be just taken to the statement of profit or loss. Yes, it will be treated as depreciation. And you add it to the accumulated depreciation. This one here, this provision for depreciation here. That same 500, which we're taking as depreciation, you add it to this 4,000 here for this provision for depreciation here. Yes. So the new value of the computer is 7.5. Then you add that 6,000. So the total value 13.5. Mm, yes. Yeah, I think that will be better because if we start with the table, then we come to this adjustment, then we go back to the table, we'll be jumping around too much. Yes, we'll be jumping around too much. Yes. Yes. Some of these tabulations, you can put them, you can show them in the statement of profit or loss. Some of them you can put. But you have to show these workings, madam. Yes. You have to show the workings before you make your thing, your your financial statement. Financial statements. Okay. Okay. Depreciation is charged on all non-current assets owned at the end of each year as follows. Equipment, it's the rate at the rate of 25% per annum using the reducing balance method. For computers, we've done fixture and fittings at the rate of 15% using the straight line method. So, as I said, depreciation, loss in the value of an asset. So, the reducing balance method, this is how you use it. This is the formula. Cost, value or the value of the asset minus accumulated depreciation. So in this assignment, since they're using provision for depreciation, so let me not confuse people. They're the same term. Provision for depreciation, accumulated depreciation, same thing. Okay. Yes. Minus provision for depreciation times the rate. Okay. The value of the computers 70,000. I believe it was 70,000. Value of computers 70,000. And what's the provision for depreciation for equipment? 17,500. Yes. So you're going to do 70,000 minus 17,500. What value do we get? Let's get our calculators. 70,000 minus 17,500. You get 52,500 multiplied by 25%, 13,125 kwacha. So pay attention, colleagues. This amount is going on the statement of profit or loss. Then, as I said, with depreciation, once you've calculated the depreciation charge, you add it to the provision for depreciation. Okay. This 17.5, the area provision, plus this new amount, 13,125, our provision for depreciation, 30,625. So this is the amount you see on the balance sheet for provision for depreciation for equipment. Any questions? Okay. This depreciation charge for this year, we're adding it with the previous provision for depreciation for equipment. The way it works with depreciation, every year you calculate the depreciation expense. That expense, you're going to put it in the statement of profit or loss. Then that same depreciation expense, you add it to the provision for depreciation, and that's the amount you put on the balance sheet. Are we okay with that, or you want to see how the depreciation account works? How these accounts work? Do we have enough time? Okay. Maybe in the next class. Is that okay, sir? Yes. But remember this. Here is just a snippet. Okay. Every time there's depreciation. Okay. This is the journal entry. Okay. You're always going to debit the depreciation expense. And you credit the provision for depreciation. Every time there's depreciation, that's what you do. Okay. Provision for depreciation. So at the end of the year, okay, you close this account. Okay. But this provision for depreciation, every year it's growing. It's growing. It grows, it grows, it grows, it grows. Okay. It keeps on growing until the value of the asset reaches zero. Okay. So I will show you how it works next time with the T account so that you but when you're dealing with financial statements, just remember this. Once you calculate the depreciation expense, put it to the statement of profit or loss and add it to the provision for depreciation. Can we write that down so that next time we're not confused? Once you've got your depreciation expense, put it on the statement of profit or loss and add it with the provision for depreciation. Is that okay, colleagues? So even like for fixture and fittings, the same thing is going to happen. All right. They told us depreciation for fixture and fittings, 15% using the straight line method. Now the straight line method is easy. Just multiply this amount by the value of the asset. So fixture and fittings 1,400. Okay. Oh, that's the provision for depreciation. Sorry. Fixture and fittings, the value is 3,000. Okay. So to get the depreciation using the straight line method, you just multiply 15% times 3,000. Okay. 50% of 3,000, that's 450 kwach. So just like the same that we did for the equipment, this 450 kwach It's going to go in the statement of profit or loss. And then this same 450, you're going to add it to the provision for depreciation. Okay. So for fixtures and fittings, the provision for depreciation was 1,400. You add plus 450. Okay, 1,400 plus 450. Provision for depreciation 1,850. Are we okay with that, colleagues? The same thing we did with equipment. We got the depreciation and we also added to the provision for depreciation. Even for the computers, that 500, you're going to add it to the provision for depreciation. Okay. First, find out the loss in value. This is where we did the 8,000 minus 75. We get the loss in value, which you can equate to depreciation. After you find the loss in value, okay, add this 6,000, which you removed from this 8,900, so that you get the new total value of the computers. So 75 plus 6,000, then you get 13,500. Then this 500 here, it will be in the statement of profit or loss. Then you add it to the provision for depreciation for the computers. This 4,000 here, those are the provision for depreciation for the computers. You add plus 500, 4,500. I'm telling you. You know what? Okay, this I want this question is involving. There are a lot, like you have to be able to spot a lot of things here. It's very involving. I think that's why I gave it to you as in groups, because it's involving. It's involving. The other questions, you find the adjustments are late. Okay, we'll go to the next one. The 5% bank loan commenced on July 1st, 2023 and is considered long term. Okay, so this loan starts from July and then so it's going to end in June the next year. Okay, so here we need to find out how much interest needs to be paid for the timeline of from July to the end of the year. Okay, that's what we need to find out first. How much interest needs to be paid from the time the loan begins up to the end of the year. Okay, colleagues. So this is what you do. You count from July 1st to 31st December. How many months are those? 1st July to 31st December. So we count together. Since it's 1st July, so you include July. So July, that is one. August, that is two. September, that is three. October, that is 4, November, that is 5, December, that is 6. Okay. What we're trying to do here, colleagues, we want to find, since the loan has started mid-year, okay, we want to find out how much interest do we need to pay for this loan from the time it began to the end of the year. Okay, colleagues? From the time the loan began to the end of the year, how much interest do we need to pay? Okay. So from July to December, there are 6 months. Okay. 6 months. Okay, so we need to find out, okay, so what is the monthly charge for the interest? The interest is 5%. The amount of the loan is 20,000. So interest for the year that you have to pay per year is 1,000 kwacha. Okay, that's the interest that you have to pay for the year. Now, for this loan, since it started in July and we've only done 6 months, so we want to find out of those 6 months, how much interest do we need to pay? So we get the monthly charge of the interest. 1,000 divided by 12, that is 83.3333 kwacha per month. Okay. If we have to say the interest, if we're paying in monthly terms, it's like you're paying 83 kwacha per month. So 6 months passed, and the monthly charge for interest is 83.33. So you do 83.33 times 6. Yes, colleagues, 83.333 times 6, what you get? Yes, rounded off, it is 500. Okay. So from July to December 31st, we have to pay 500 kwacha in terms of interest. Any questions? Mm-hmm. The loan began mid-year, so we are not going to have to pay the full interest amount for that year. All right, sir? Yes. So we have to find out, okay, since it began in July and is ending in December, that is 6 months. So how much interest do we need to pay for these 6 months? So in order to get the interest you need to pay for the 6 months, step one, get the yearly charge. Okay, step one, get the yearly charge, which we got as 1,000. This is the yearly charge. After you get the yearly charge, get the monthly charge, meaning you divide the yearly charge by 12, and we got the monthly charge. So since we have the monthly charge and we know for how long our the loan is running for this year, we just multiply. Since it's running for 6 months, so we just multiply 6 times the monthly charge. That's how we got 500. Bank charges and interest included 200 kwacha interest charged on the 5% bank loan. So basically here, the interest that we paid for this year is 200 kwacha. when we were supposed to pay 500 kwacha. So you just do 500 kwacha minus 200 kwacha, 300 kwacha, which we are owing in interest. Okay. We've only paid, was supposed to pay 500, but we've only paid 200, which is included in that bank charges and thing. Okay. That amount is included in that bank charges and thing. Bank charges and interest charge. Okay. So we were supposed to pay 500, we've only paid 200. So we're owing interest of 300 kwaj. Are we okay with that? So we are owing this 300. Okay, now I need to be switching with the third years, but let me just do this final one here so that next time we meet, we can just proceed from where we've left off. Allowance for irrecoverable debts is to be 150 kwacha. So this is the thing that you have to do whenever there's allowance for irrecoverable debts. Okay. If you see an amount like how we saw here, where is this? Where is the allowance for it? Uh-huh. We've seen at first the allowance was 250. Okay. Now at the end, the allowance has reduced to 150. Okay. You have to compare the two first. Okay. At first, remember allowance for recoverable debts, this is money we're estimating that may not come. Okay. So at first we estimated we might not get 250 kwacha from our receivables. But then at the end of the year, we estimate that we won't get 150 kwacha from our receivables. So it means our allowance has reduced, right, colleagues? Because at first it's 250, now it's 150. Okay. So it has reduced. Meaning you find out how much has it reduced by? You say 250 by 100, yes. Yes. So that 100 kwacha, you take it like that 100 kwacha, you might get it from your receivables, okay? Because at first you said we might not get 250. Then at the end, we might not get 150. So it means that 100 kwacha difference, you might get it. Yes, sir. Yes, Mr. Frederick. Yes. So at first you estimated you might not get 250. At the end of the year, you estimate you may not get 150. Okay. The reason why this amount changes from the beginning of the year and at the end of the year, because your receivables balance, it's not always constant. It's also changing. And this allowance is usually a percentage. Okay. It's a percentage got from the receivables. So here in this case, they already did that calculation for you. So the reason why it changes, it's because your receivables value also fluctuates. So the percentage at the first of the year will be different from the percentage at the end of the year. So you need to compare the one at the beginning of the year and the one at the end of the year. So in this case, the one at the beginning of the year was 250, which we expected not to get from our receivables. Then at the end of the year, It's now 150. So that 100 kwacha difference, we might get it. So that 100 kwacha difference, you're going to treat it as a gain, not income, but a gain, because you might not get it. Okay, you might not get it. These are estimations, so you treat it like a gain. Okay, but gains are also treated like income and whatever. So it's treated like a gain. So that 100 kwacha gain, you're going to add it to the gross profit. Okay, you're going to add it to the gross profit, and then this 150 kwacha, which you're expecting that you might not get at the end of the year, you subtract it from the receivables amount. Okay, you subtract 150 from this 2,600 in the balance sheet. Any questions? Okay, so you are always going to compare the allowance at the beginning of the year and at the end of the year. If there is a reduction, it means you might get your money back, so it's treated as a gain. Okay. If there is an increase, it means you might not get more money, so it's more like a loss. Okay. If there's a reduction, it's a gain, treat it like income. If there's an increase, you treat it as an expense because the amount of money you might not get has increased. So in this case, madam, when you compare at the beginning of the year and at the end of the year, we saw that there was a reduction. A reduction by how much? 100 kwacha. So that 100 kwacha, you say, well, you might get it. So you treat it as a gain. Okay? You treat it like a gain, meaning you add it to gross profit. Any questions? Any other questions? If it was the reverse, okay, if it was the reverse and we saw this allowance for receivables increased, okay, you are going to tabulate how much is the increase. So if let's say there was an increase of 100 kwacha, that's extra money that you might not get. Okay, that's extra money you might not get. So money that you might not get, you treat it like a loss, right? And then money that you might get, you treat it like a gain. Remember, allowance for recoverable debts is an estimation of money you might not get. Okay. When you do credit sales, not everyone's going to pay you. So we have to estimate. Okay. Yes. Mr. Foster, any questions? Madam Sylvia? Before I end this class, I have to go through everybody because this is accounts. So let's start first. Okay. Mr. Twambo, are we okay with that? If you're not okay, it's all right. You can say, Asa, this accounts, no. Mr. Foster, if you're silent, I'll assume you have got it. Okay, I'll assume you got it. Mr. Foster, Mr. Frederick, Madam Yvonne, ask your final questions um, before I log out. Ask the final question. I've got a spare 20 minutes to explain.